The S&P 500 is very close to breaking down after putting in a very minor topping formation, so we'd be very cautious here in the short term. Hi, I'm Mark Arbiter, and this is S&P's Chart Room. Taking a look at a daily chart of the S&P 500, we wrote last week that when you break out of a bullish channel and then fail, which we did during this week and late last week, you have the tendency to pull back to your 50-day or back to the bottom of the channel. Before we do that here, we have to break this 1635 level. There was a ledge of support that ran for a couple days, very minor support, as well as the couple days last week that we bounced off of this level. Today we're getting down to very close to that chart support area. And we think once we break that, we'll open the door to a move down to this box or this area of technical support. There's a couple key pieces of support there. Of course, it's the bottom of the bullish channel that we've been in since December, and this includes the move since last November. It also coincides with key chart support. This was the last breakout area around the 1597 level. We had two highs here, an inverted head and shoulders right here, and then we broke out and then moved to new all-time highs. So the last breakout area here is key support, and that is around the 1597 level. And in addition to that, the 50-day simple moving average comes in just below the 1600 area, so that also represents key support. From a longer-term perspective, what has us still, somewhat bullish here is there has not been any major topping formation traced out during this entire rally. We've had small topping formations traced out, but at this point, the S&P 500 as well as some other major indices don't look like they're putting in major intermediate term topping formations, which would suggest, and if they do, would suggest, we finally get that 8 to 10% correction. Is this the makings of a left shoulder and head? That would take a lot of damage to complete. If this is the head, we'd have to come down to the left shoulder, which is around the 1550 or 1535 to 1540 area here. The neckline would be way down here, and it would suggest, probably more, if that was the case, more than an 8 to 10% correction. So from a longer term perspective, what we might do here, and it's because, one of the reasons because this move has been so strong, is that any weakness or decent sized weakness back to support would probably represent a decent buying opportunity. We may work off overbought conditions on a daily, weekly, and monthly basis with price decline as well as time. If the market just trades sideways here, let's say we bop down to the low 1600s, high 1500s, and then go sideways during the summer months, we can work off some overbought conditions from a weekly and monthly basis without seeing too much price damage. So that's a possibility right now as we move through the summer months. This has been Mark Arbiter with S&P's Chart Room.